The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Very good morning to you and a warm welcome to Squawk Box Europe. I'm Juliana Tatelbaum with Steve Sedgwick this morning, and these are your headlines. A global bond market rout sees long-end yields on UK and French debt touch multi-year highs as fiscal worries weigh on investor sentiment.
China flexes its military muscle with tanks, missiles and thousands of troops parading through Tiananmen Square, whilst the President Xi Jinping plays host to Russia's Vladimir Putin and North Korea's Kim Jong-Un. And Google scores a big antitrust win as a US court rules it does not need to offload its Chrome browser. It says the tech giant must share its search data with rivals. Certain things in life are inevitable, and as you get older, you know that they are inevitable, but you just get on with your life and you don't worry about the things you can't control, and you just deal with today's challenges.
Wise advice?
Wise advice, perhaps, yes, indeed. It's kind of almost Taoist in its philosophy. And I feel like that a bit about the bond market as well. There is a trajectory which appears to be inevitable, which at some stage, and you know I've been reading extensively about this recently, even more so than I normally do.
And
I've been studying debt for as long as I can remember and speaking to people like Tim Adams, who does his global debt monitor on a quarterly basis. And it is there. It is ever present. The debt loads of developed and developing nations are expanding. I wouldn't say exponentially, but at a very steady rate to areas which are uncomfortable. When Reinhardt and Rogoff wrote the seminal work post the financial crisis, they said 90% debt to GDP is pretty much a tipping point. Now, a lot of people disputed some of the empirical evidence, but that was what they came up with. Now we are looking at levels in developed and developing world debt, which are getting to 100, 110, in some European countries' cases, near 150. In Japan's case, over 200% of GDP as well. The question is when this becomes a problem.
Yeah.
So it's there, it's ever present, like a lot of other problems in life, and it is only going one way. The question is when the bond markets really start worrying about this as well.
And you don't want to be too early to this theme.
You don't want to be too early because what is that phrase we keep saying? The bears make sense, the bulls make money as well. And if we look at the 10-year bonds at the moment as well, we can see a degree of stress. But I would argue not an extreme degree of stress, especially on the 10-year on the US paper at 4.287. That is not telling you there is distress broadly in the bond market. When you look at the 30-year, then, and this steepen the trade we've spoken a lot to you about and to our guests over recent weeks and months and what have you, it is definitely picking up. And the degree of stress, if it is being seen anywhere, is in that long end as well. The question is now the time to start worrying about it?
Well, I think looking at the GBs, you look at UK gilts, we're at 5.7% for the 30-year. A lot of focus yesterday on the action that we saw in gilt markets. The rise in yields didn't hamper yesterday's gilt auction. Interestingly, with the UK selling 14 billion pounds of new 10-year bonds, the highest yield since 2008. The record sale came despite fiscal concerns ramping up pressure on UK assets as investors brace for Chancellor Rachel Reeves' autumn budget. Let's welcome our first guest, Callum Pickering, to the program, Chief Economist at Peel Hunt. Callum, it's so good to have you this morning.
Good morning. Thank you for having me.
Every time we have you, I say it's a perfect day to have you, and I think today is no exception. Let me just kick off with your take on what drove the escalation in concern in bond markets yesterday. We've been tracking the 30-year yesterday. We've seen yields now rise to the highest level since 1998. What do you think triggered the latest selling?
Well, again, you say this already, but let me echo the point. This is a problem for the advanced world, and then we're discussing here the relative spreads. The specific issue with the UK is twofold. First, we have a bit more inflation near term than other advanced economies, so markets are pricing in some inflation risk. That is the product of largely policy errors and policy choices, which has amplified concerns that the government doesn't have a compass which points in the right direction when it comes on economic policy. Then you have some structural issues in the UK market, which is, especially at the longer end, yes, sterling's a reserve currency, sort of in name only. It's the smallest of the 4 reserve currencies, and the debt market is the smallest, and you don't have the natural buy that you have in Japan. You don't have the hard currency aspect that you have with the euro. It's not the exorbitant privilege that you get with the dollar. And so you find a world in which you say, well, we can issue debt. This is not a problem. Okay, debt's there, but we don't like the price that we're paying for this debt. And the price that we're paying for this debt is actually an economic problem. And this is true around the advanced world, by the way. Just because you don't have a crisis in the bond market doesn't mean that these interest rates are not having negative economic consequences. They constrain policy choices, they crowd out private investment, they leave us wondering every 6 months whether we're going to suffer about financial instability. This is really, really bad for the private sector. I'm actually getting to the point now where I think that austerity would be stimulative because you would actually give markets confidence, you would bring down these bond yields, and the private sector would just breathe a sigh of relief and start dispensing some of its balance sheet strength.
That's such an interesting notion, and it feels like governments, including the UK, or notably the UK, are so reticent to really tackle the budget issues at hand because it's so politically unpopular, I guess, to rein in spending, raise taxes. But you're saying, actually, from a bond market perspective, that's what bond investors want to see, austerity.
That's right, and I would just mention the point, and of course it's not your point, but the idea that austerity would be unpopular at this stage. Actually, I find that's a lazy argument because I think most voters will say high on their priority list is actually financial stability. No one wants to see taxes increase significantly. I mean, we've gone down this 25-year journey of ever raising taxes, ever raising borrowing, and the result has been bad. Weaker and weaker economic growth, weaker and weaker productivity, and now we're staring at these huge long-term liabilities because we now understand that we have real consequences of an aging population, and bond markets are starting to creak. Now, the economics of this is actually fairly straightforward. You could cut major parts of spending, especially on things like welfare. That would reset incentives in things like labour markets. You could deregulate major parts of the economy so that you would have more economic pie to tax. None of those are options that are available for Labour. They've constrained their political choices. And if you just go through both sides of the budget, no raise in VAT, no raise in income tax, no raise in employee national insurance, that's 2/3 of the tax base. They failed to pass reforms on welfare, that's 300 billion. Then you have NHS, education, defence infrastructure. You're not going to touch any of that realistically. So you've constrained your own policy choices. And so we're sweating over whether a government with a 3 trillion economy can raise 20 billion in a budget. It's not because the bond market won't let you make adjustments. It's because you've prevented yourself from taking the choices that could get you there.
The other issue that is very contentious at the moment is whether Rachel Reeves is a good steward of the economy as well. And this week there has been a reshuffle within government where she's lost her deputy to number 10 from number 11. Just for our international viewers, number 11 is where the Chancellor apparently lives, although it's a loose arrangement. And number 10 is where the Prime Minister is. And the argument from some press was that she's been defanged by losing her very important deputy as well. Is Rachel Reeves' tenure at number 11 Downing Street a key here, or does it not matter?
I think there's a risk that we might see a change in Chancellor. At this point, and I think the way to describe, or to summarize what you've just said is the weight of economic policy making, the gravity is shifted from the Chancellor to number 10. This creates both an opportunity and a risk for the government and Keir Starmer. It's an opportunity because it will allow him to make some changes and say, actually, this is not coming from the Chancellor, this is coming from the Prime Minister. MPs just have to back this. So any worry that it was her political weakness that prevented, say, the welfare reform, maybe you can overcome that. The danger is, now that the market realises it's number 10, the Prime Minister's office, which is largely dictating economic policy, whatever happens in the budget is on the Prime Minister just as much as it is the Chancellor. What I wouldn't be surprised if we think about risk scenarios, let's say the government starts briefing against the Chancellor and saying, well, it was Rachel Reeves who wanted to not raise taxes on VAT, income tax and employee national insurance. This was never the idea. This was the Chancellor's idea. basically force her to raise income taxes, then she resigns, and then you put someone else in. That may be the early stage that we're seeing unfold, but I'm not sure.
Okay, let's put this back into the context where we started the show. There is a global trend to being more cautious on earning longer-term bond instruments as well. It's a question I raised a long time with Andrew Bailey, the governor of the Bank of England, and I have to say at the time I thought that the official view was quite dismissive of my concern that a ripple in the United States or somewhere with a bigger economy, more significant global economy, could create enormous tsunami-like conditions for countries that rely on the kindness of strangers, for instance, United Kingdom as well. How much do we have to worry about the US 30-year affecting what's going on in the British bond market?
The US is the conductor of the global economic orchestra. You know, whatever happens in America then reverberates. Exclude gold, and the US Treasury is the ultimate safe haven in the world. Everyone is then benchmarked against that. So implicitly, if the US Treasury market is becoming a riskier bet, the gilt market is becoming a riskier bet. But there's a point here which I should just highlight. There's in one respect, and again, I find these arguments a little bit lazy, but there's a kernel of truth. Who really cares about government debt? Actually, you borrow in your own currency, you can print that currency, you can always meet your liabilities. Actually, that overlooks an important fact. When you accumulate liabilities in the private sector, generally speaking, you also generate an asset. What we've done is we've raised government debt levels over the past 25 years, largely to finance current spending through a succession of crises. And so you don't have the assets on the other side of the balance sheet. And now what the market is worrying about is, where are the assets which finance the pension liabilities? Where are the assets that finance the healthcare and welfare liabilities as we all get older and as we fall into retirement? The first government that bites the bullet and resets fiscal policy and starts being clever with its policies. Do you provide tax cuts for young people and take that money and invest it in long-term assets to provide for pensions? How do you de-risk the long end of the balance sheet? Once a government bites the bullet or is forced to bite a bullet, the market will react very positively, I think, and you'll see economic effects.
Asking a government to be brave and long-term and look beyond their own five-year parliament is a stunning ask as well, and it is a hot topic of conversation, of course. Which government has been brave enough to make meaningful reforms? And I have to say, I was at quite an influential dinner last night in the city, and the fear was that the next government could be reform and they would not be making those decisions as well. But we'll have to leave that for another day, I'm afraid. I know I've just kind of given you a carrot that you're just desperate to buy it. In fact, do you want 20 seconds on if that would be the case? If reform was the next government, how worried would you be?
It depends. If Reform were in coalition with the Conservative Party, which knows how to be in government, and you got the good stuff and you didn't get the bad stuff, I think markets might take that well. The danger is the market would anticipate a repeat of Truss.
Brilliant. Okay, Roger, will now let us end this interview. Thank you. Insist upon it. Callum, lovely to see you, sir. Thank you very much indeed for your time. As always, brilliant, and we learn a lot. Callum Pickering, chief economist and now an advocate of austerity. Almost, he said. Peel Hunt, thank you very much indeed for that. That's another conversation for another day. France's far-right National Rally Party has called for snap elections and urged the President, Emmanuel Macron, to dissolve Parliament, as Prime Minister François Bayrou holds crisis talks in an effort to prevent his government from collapsing. Speaking to the Financial Times, French Finance Minister Eric Lombard said concessions to the government's budget plan would be inevitable if Bayrou is ousted next week. Chinese President Xi Jinping has been joined by more than 20 world leaders as he hosted his country's largest ever military parade in Beijing, marking the 80th anniversary of the end of World War II. Russian President Vladimir Putin, North Korean Supreme Leader Kim Jong-Un were amongst those in attendance, drawing the ire of the US President Donald Trump, who accused them of conspiring against America. Speaking at the parade, Xi gave his take on the world's challenges.
Today, humanity once again faces a choice between peace and war, dialogue and confrontation, mutual benefit and zero-sum outcomes. The Chinese people firmly stand on the right side of history and on the side of the progress of human civilization. We will adhere to the path of peaceful development and work hand in hand with people of all countries to build a community with a shared future for mankind.
Elaine, we are privileged in our job, but for you to be in Beijing at the moment, a very, very, I think, historic time as well. Fantastic. Give us your take.
Yes, there was a lot of build up to this parade, and it took place to project this military and also political might. So the parade is both operationally and symbolically significant. We saw the latest weaponry, Beijing showing off its advanced weaponry and military hardware. For example, the hypersonic missiles that Beijing described as China's deterrent capability, and also more high-tech unmanned system where that could be the future of combat with robot dogs on display, which Beijing says is it adapting to sci-tech developments. But also we saw nuclear missiles parading down the avenue in the presence of leaders such as North Korea's Kim and Iran's president and also Putin. So that when that nuclear missiles came out, it drew applause from the spectators as well. So just really that might that China is projecting, and state-affiliated media said China is more confident today now, as shown by the aircraft carriers and also a trending liquid intercontinental ballistic missile that is now a hashtag that can strike any target around the world. Steve.
Yeah, a fascinating time, and thank you very much indeed for your coverage, Elaine. We'll see you a little bit later on as well. And for more on China's display of military might, head online to CNBC.com. Juliana.
Coming up on the show, a U.S. court delivers its antitrust ruling on Google. We'll tell you what it means for the search giant. Plus, we'll look at Klarna's massive valuation swings as the Swedish buy now, pay later platform finally heads towards a U.S. listing. But before all that, we'll be joined by Andrea Rossi, CEO of M&G, after the UK investment company posts a first half pre-tax profit miss. Those numbers and that conversation next.
Okay, welcome back. M&G posted a first half adjusted pre-tax profit of £378 million, missing the mean of analyst estimates. The UK investment company says it is well positioned to navigate the current economic environment, pointing to momentum across its asset management and life businesses, and the inflows of $3.5 billion will catch many people's eyes as well. Let's get to Andrea Rossi, who is the CEO of M&G. Andrea, always a privilege to speak to you as well, sir. So look, inflows look good. Are you unhappy with my characterization of the profit miss?
We are very, very pleased with, obviously, the flows. On the profit miss, I'd like to say that when you look what we have delivered, we're up 1% on adjusted operating profit, and we had some one-off headwinds that will not recur in the second half. Without those two one-off headwinds, we would have been plus 5%, which is exactly in line with the guidance and the target we have of 5% growth of operating profit on average per year. So we're very, very pleased. But I really would like to insist on the amazing growth we have delivered. The net flows of 2.6 billion sterling for our asset management business is the highest since we listed in 2019, and shows that we have strong investment capabilities. But more importantly, thanks to our strong investment performance, we have been able to attract a lot of different clients out there.
To their attractive money, because I think, as I say, the inflows have definitely caught my eye, Andrea. But just talk to me, and just to the market as well, because they'll just want to clarify this point as well. The headwinds that won't occur next time round, just go through those for us, would you?
The headwinds was an investment income loss on the asset management side, and then there was a legacy contract, so an old contract that we had to pay on the life side. So in both businesses, two headwinds that will not occur in the second half, and therefore it gives us confidence that we will deliver. Also thanks to the momentum we have in the business. Let's not forget, when you look at the asset management business, our cost-to-income ratio has improved by 2 points year on year. It's at 75%. It was at 77% 1 year ago. And of course, if you look from fee-related earnings, so this is revenue minus cost, up 14% for the asset management business. So we have good momentum. And of course, this is supported also by the fact of the net flows, but also the partnership that we have done with Dai-ichi Life, the largest listed Japanese insurer with a $310 billion balance sheet. They chose us as their preferred asset manager for Europe, given the strong investment performance, but also our strong private assets capabilities. And that will help us to grow in the future, in the coming years, to have a commitment of at least $6 billion over the next 5 years.
Andrea, talk to us a little bit more about the inflows that you're seeing. Clearly a key highlight of the results this half. Where are they coming from a client, a regional perspective?
Well, the inflows, and I like to say, I mean, Europe, there's been a renaissance of active asset management and of Europe. Many investors, international investors, have increased their allocation into Europe. Institutional investors that want to have more allocation to private assets, in particular to real estate. They've been feeling that the cycle is the right time to enter that, both real estate equity and real estate debt. And of course, a lot of appetite also on private credit and structured credit. We've seen several investors, both from Asia, Middle East, and Americas actually increasing there. And let's not forget about public markets. There's been a lot of interest into public equities. We have a European equity fund that had 1 billion of net inflows during the first 6 months. So that on the institutional side, I would say it's been a lot of appetite into Europe and private assets in particular. And on the wholesale side, because of our stellar investment performance, we saw inflows of 700 million. And that's thanks to, I would say, investment performance that has been in the top decile. Roughly 20% of our funds are there, and therefore it has been attracting a lot of momentum with our distributors and their clients.
It's really interesting to hear you talk about the interest from international investors in Europe. It was certainly a story we heard a lot about in earlier this year, but in recent weeks, the narrative appears to have shifted slightly. Certainly when you look at public markets, that perhaps that narrative is reversing once again, and we're seeing that renewed interest in Europe leave. And we've seen this in flow data from various sell-side analysts in recent weeks. Are you seeing any sign of that in the most recent activity, and as we head into the second or the back half of the year?
We continue to see momentum into public equities in Europe. When I look at our July and our August figures, we continue to see those flows. It obviously is linked to investment performance that our fund has been delivering, but also I would say valuations that remain still relatively attractive when you compare them to US. But there is no doubt that in the first half, you saw probably a little bit of risk off from the US and more allocation into Europe. I believe after the Liberation Day, things sort of calmed down in the US, and you saw very quickly investors moving back into the US market. But Europe remains still very, very attractive. Valuations are attractive, of course, but more importantly, I would say the agenda in Europe of investing into energy, technology, and defense, that has also attracted a lot of money. And of course, you might say Europe is a little bit more stable. Of course, we've seen in the last 24 hours a little bit of issues concerning debt and debt deficit. But overall, I would say Europe is in a better position than it was several years ago. And I've been in this business for decades. I've been trying to sell Europe every time I've gone around in the world. You know, I'm half Italian, half Swedish, live in London. I've never seen so much interest into Europe as in the last 8 months.
Yeah, and Andrea, I'll give you as a sneak peek. You and I have had a very long conversation about a lot of this kind of stuff, and I hope to bring it to them very, very soon, but we'll do that on another occasion. But my final question for you is something that you've been advocating equally as passionately about is Europe, and that's private markets as well. And your own company, of course, made some significant investments in there as well. I've had some very big conversations about private markets with some city bigwigs, including yourself, in recent days and weeks as well. And it seems it needs just that little bit of a nudge still from the government to invest domestically, to invest in the UK, invest in Europe as well. How are we getting on? Are we backing our own companies in the private markets enough? If not, what do we need to do, Andrea?
Well, private markets in Europe is still growing, and when you compare it to the US, there is certainly more to do. Obviously, we welcome governments wanting to push more into infrastructure, both in the UK and in Europe. And of course, governments have limited resources. We talked about, you talked earlier about the government debts being 100, 110, 150% of GDP. So they need the private markets to take that place, and we are doing so. So we see a lot of momentum on infrastructure projects. And of course, when you look at private credit, banks are retrenching their balance sheets, and that's an opportunity for alternative asset managers like ourselves to dig in and be able to provide solutions both to SMEs and larger companies. So we see a lot of opportunities here, and we have one of the largest franchises with 77 billion sterling. And of course, we've also been doing selective bolt-on acquisitions here in Europe because we believe that Europe will be a growing ground for private assets moving forward, in particular on private credit, real estate and infrastructure.